Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Europe podcast, available every morning on Apple, Spotify or wherever you listen. It's Wednesday, the 28th of August in London. I'm Stephen Carroll. Coming up today, HSBC's incoming CEO considers cutting management layers in a sweeping overhaul of the bank. China's economic challenges drive an increase in protests over work and housing. Plus, an increasingly checkered outlook leaves Burberry facing the end of its HSBC is considering plans that could remove layers of middle management at Europe's largest bank. Bloomberg understands incoming CEO Georges Elhedery is looking at making cuts that would mirror similar moves at rivals Citigroup and Standard Chartered. Our colleague Adam Haig has the details.
This is the first sign of what we're seeing from the new CEO and really wanting to make his mark early on in terms of the cost control. So what we know at this point is that it's likely to affect middle management roles. So that could include country head type roles in some of its global network. But there's still uncertainty as to how this plays out. And of course, these plans are potentially subject to change, of course, as well.
Adam Haig and the team behind the exclusive Bloomberg reporting say Elhedery is also likely to make changes to the executives and roles that will report to him after he takes on the top job next month. The discussions are the latest sign that the bank is looking to rein in costs as rate cuts threaten the margins of global lenders like HSBC. A spokesperson for the bank declined to comment on the story. Protests are on the rise in China as the effects of a slowing economy rattle citizens. Figures from the China Dissent monitor from the US advocacy group Freedom House show cases of dissent increased 18% in the second quarter compared to the same period last year. According to the report, the majority of protests were linked to economic issues, with 44% related to labour and more than 20% involving aggrieved homeowners. Although the report doesn't provide a full picture, it does offer a snapshot of sentiment across China as the country grapples with slowing GDP growth, a real estate crisis and an expanding trade war with the United States. Joe Biden's top national security aide has met with Chinese Foreign Minister Wang in Beijing. Jake Sullivan is the first US National Security Advisor to visit the country since 2016. The two held a full day of talks on the outskirts of the capital. Wang says the cooperation is the goal.
Over the past few years, bilateral relations have gone through twists and turns. The key is to keep the overall direction of mutual respect, peaceful coexistence, and a win-win cooperation. Implementing the common understanding between our two presidents as their San Francisco meeting is our important responsibility.
China's Foreign Minister Wang there speaking through a translator. Sullivan's trip comes just months before the US presidential vote in November. Both candidates in that race are set to maintain a tough stance on China, but Republican Donald Trump has threatened a blanket 60% tariff on imports from the country. FTSE 100 veteran Burberry is set to exit the benchmark index. It comes after an industry-wide slowdown and a faltering brand revamp. Bloomberg's Tiwa Adebayo has the details.
Known as a hallmark of British apparel, Burberry could be set to bid farewell to the country's financial big leagues. According to a FTSE Russell statement, the stock will likely drop down to the mid-cap 250 index at September's quarterly rebalancing. Shares have slumped by a third in the last 3 months, hampered by a softer Chinese market. But efforts to revitalise the brand with a return to its British roots also stalled as the company faced a recent profit warning. Insurer Hiscox and real estate investment trust Tritax could be candidates to take Burberry's spot in the blue chip benchmark. Final changes to the lineup will be announced on September 4th after European markets close. In London, Tiwa Adebayo, Bloomberg Radio.
The UK and Germany are working on a major new treaty. Bloomberg has learned negotiations will involve cooperation on defence, technology and clean energy. James Woolcock has more.
Less than a week after Labour's July election win, Foreign Secretary David Lammy landed in Berlin. Now, Starmer himself heads to Germany in one of his first foreign policy initiatives. The goal is a major bilateral agreement, potentially even matching Britain's joint military training with France. Sources tell Bloomberg that negotiations are unlikely to be completed before next year, but both sides are looking to have a deal on security within the next few months. In London, James Woolcock, Bloomberg Radio.
The number of UK properties up for sale has hit its highest level in 7 years. Zoopla says demand from buyers is rising as a recovering economy boosts consumer confidence. Industry experts point to political stability and expected interest rate cuts as signs of future growth. In a moment, we'll bring you more on our story on HSBC and the planned steps being taken by the new CEO, plus more details on that report about Dissent in China. But first, will you be joining the scramble for Oasis tickets when they go on sale on Saturday? The long-awaited reunion of the Gallagher brothers already starting a frenzy among fans desperate for tickets for their UK and Ireland dates next summer. Bloomberg's Charlie Wells has been speaking to some of those who will be opening multiple devices for the online queue, including some who say they'll pay whatever it costs to get in. Interestingly, Charlie also points to the wider trend of people spending more on experiences like concerts since the pandemic. Think Adele in Munich or the Taylor Swift Eras tour. One study in the US found those who are considered to be Gen Z and millennials have spent at least $500 on tickets for live events, and another 38% were willing to take on debt for such a discretionary purchase. So we'll be seeing who manages to win out when tickets go on sale on Saturday morning, and crucially how much they're willing to pay for those prize seats. Let's bring you more now on our top story. Sources telling Bloomberg that HSBC's incoming CEO, Georges Elhedery, is considering stripping layers of middle management, including cutting the number of country heads. Our senior Asia finance correspondent, Ambereen Chowdhury, was part of the team that broke the story. She joins us now for more. Ambereen, great to have you with us. What are the changes then being considered by Georges Elhedery?
So, as you say, the new incoming CEO, Georges Elhedery, basically examining plans that could remove layers of middle management at Europe's largest banks, and that's sort of mimicking similar moves undertaken by Wall Street rivals such as Citi, and of course you have the smaller Asian focused rival Standard Chartered, who's made similar moves along the same lines. And as part of these discussions, the London-based lender could potentially cut the number of country heads operating across its worldwide network, according to our sources. The new CEOs are also likely to make changes ultimately to also a number of executives and roles that report directly to him, and he's due to take the reins next month. But this whole scenario is at the moment just under discussion, and as part of that, nothing has been finalised.
What's thought to be the reasoning behind these changes being considered?
So these discussions are the latest sign that HSBC is basically looking to cut costs as central bankers around the world begin to cut interest rates, threatening the profits of big global lenders like HSBC. In recent months, the bank has started to slow hiring, so they're getting ready for all this basically and asking bankers to be more vigilant about their travel and entertainment spending. I mean, we've reported this previously that bankers have been told to cram in lots of client meetings within the working day, and ultimately they're just a massive, global banking lender that needs to cut costs and complexity across its many different businesses around the world.
Now, Noel Quinn, as the current CEO, had already started a process of sort of reorganising HSBC's operations, doing things like selling off the operations in places like France. Will this be seen as a continuation of that strategy, or is it a marked change in direction?
Well, in terms of non-core asset sales, it'll be continuing what Noel started. So, HSBC, just to pull back a little, it's just massive. It's got approximately 41 million customers and operates in 60 countries and jurisdictions. And as you say, they've been disposing of major businesses in North America and Europe, namely the French and Canadian businesses recently. And what it is doing is redeploying capital. And this was part of Noel's strategy as well, particularly to Southeast Asia and China, and making a deeper push into some fast-growing Asian markets. And last week, we reported that the bank is in the process of offloading its South African business. So that's something that we should see, happening under the new CEO, Georges Elhedery's tenure.
Now, Ambereen, as we look ahead to that kind of handover of power next week at HSBC as well, aside from this reorganisation and the cost cutting, what are going to be the other key challenges that Elhedery is going to be facing as he takes on this massive job?
Right. Well, cost is at the center of, their strategy in the coming years. Their expenses in the recent reported quarters have been at a relatively high level, and it's remained fairly static. So the new CEO really needs to focus in that. And they operate in so many countries and territories, so they need to cut complexity for a variety of reasons. And finally, and a very important point for HSBC, they are continually juggling the geopolitical tensions between China and the West. It's long been an issue for, a big multinational like HSBC. Although it's headquartered in London, it generates most of its earnings in North Asia. So that's going to be a big diplomatic challenge for the new CEO who starts next week.
Okay, plenty to follow on that. Ambereen Chowdhury, our senior Asia finance correspondent, thank you very much for joining us with the details of that story and that exclusive reporting from Bloomberg about some of the changes being considered as they await that change in CEO. Well, meanwhile, protests in China are on the rise as the effects of a slowing economy rattle citizens. Figures from the China Dissent Monitor, a US advocacy group, show cases of dissent rising 18% in April and June compared to last year, the majority of those linked to economic issues. For more, let's speak to Jenny Marsh, who leads our team covering economics and government in Greater China. Jenny, good to have you with us. What form does this dissent take?
So these are really sort of small instances of dissent that Dissent Monitor has sort of carefully combed through public reports and social media to capture. So this can be anything from sort of hanging a banner in the street, an individual doing that as a means of protest, disputes in online public spaces, or just like sort of acts of non-cooperation with authorities. And they're generally looking for things that sort of have high visibility, that have gone a bit viral, and also carry the risk of reprisal. So, things that essentially the Chinese government wouldn't want sort of taking hold in any big way across the country.
How is this linked to the weaker economic picture in China?
I mean, of these economic protests, they mostly focus on property issues, and then it was labour. And so all these things are sort of, mixed together. We saw the record plunge in PDD shares this week, and this is sort of reflective of this price war now that companies are looked into, as the consumer is becoming increasingly reluctant to spend, and that's because of this sort of protracted property crisis that is still kind of rolling on in China. And, the majority of Chinese people store their household wealth in property. Is sort of the big thing that everybody invests in. So when people feel like their property prices are going down, they're feeling poorer, that's causing them to spend less. That in turn is sort of having a knock-on effect on companies, which is sort of making the job market less dynamic and vibrant. So they're sort of in this cycle now of sort of a malaise. We saw youth unemployment tick up again for the first time last month since February. And even manufacturing, which has been sort of a bright spot in the economy, softened in the second quarter. And more tariffs have been imposed. We saw Canada announced earlier this week too, 100% tariffs now on EVs. So I think it's just reflective of sort of the pressures that are facing the Chinese economy coming in from all directions.
So I take your point that a lot of these, what incidents that are being considered dissent are quite minor, but do they reach a level that are likely to provoke a reaction from Chinese authorities?
I think, and the report authors are quite clear about this. Like these sort of episodes of dissent, while they're rising, they're not going to reach the bar of the sort of COVID protests that you saw at the end of 2022, which forced President Xi Jinping to rethink his whole COVID zero strategy. They are nowhere near the tenor or scale of that, but they are increasing. And I think what it does is put pressure on local governments. It's going to make it harder for them to push through policies, and it just creates a sort of friction in society that the government's going to have to deal with. There's this sort of idea in China that the contract between the Communist Party and the public is based on the fact that the Communist Party can provide, increasing prosperity and a better standard of living tomorrow than they had yesterday. And if that sort of those prospects dim, then it's a much harder population for the Communist Party to govern, essentially. So it's bringing fresh challenges to the government, but it's, to be clear, it isn't anything near sort of to something that might threaten the regime.
But of course, looking at this from a more macro point of view, and you outlined some of the recent weakness and illustrations of weakness in the Chinese economy, are there expectations that in terms of doing things to boost the economy, that there could be more to come from Beijing?
We're still waiting to see what China's government does. They've been very clear that they don't want to sort of go back to the boom and bust cycles that were heavily reliant on debt. But economist calls are growing for the government to do more, to spend more. So we had a chorus of economists, I think last week, calling for the government to raise the budget deficit ratio. More economists are now saying, giving consumers direct handouts would be like a very impactful sort of immediate way to boost the consumer. But, I think President Xi Jinping and his economic officials have been clear that they don't want to make sort of big moves and sort of resort to big stimulus. So everything is kind of incremental. So, I think for now, as they transition the economy away from one that was reliant on property, and they try and sort of build these big high-tech sort of powerhouse companies to sort of propel the economy, they're happy with a little bit less growth, with a little bit of a painful period, if that gets them to their bigger goal. And for them, the challenge, I suppose, is managing this sort of unrest, this sort of malaise within the population as they make that transition.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.